This program is brought to you by the Kentucky Small Business Development Center in Louisville. We provide the professional expertise, tools, and resources to help you succeed. To connect with a business coach, call 502-625-0123 or email sbdcinfo@uky.edu.
Welcome, everyone, to another Toolkit Tuesday. I'm Dave Etkin. I'm the director of the Louisville office of the Kentucky Small Business Development Center Network. Glad you're here today. We get requests from all over about funding their business, so we have a great guest today. But before we get to our guest, a couple things. If you wouldn't mind, just to make sure that everything's working well and you can hear us and see us good, just scroll down to the bottom of your screen there. If you put your cursor over the bottom, your toolbar will pop up and you'll see the chat feature. And if you hit the chat feature, if you wouldn't mind, just say hello and tell us your name and where you're watching from today. It's always fun to see where we have people join us from. We get people joining from all over the country and the world, and of course the States. So it's good to see you guys. So say hello. There's Janet. Janet's always in the background taking care of things for us. So hello, Janet. So just to make sure that you can see us, just say hello. Put your name in the chat and where you're watching from. So again, when a business is growing, or if you're going to start a business, you always need additional capital to buy assets or to fund cash flow and need, for working capital. And one of the best ways to get that additional money is through SBA lending. We have a great guest, and he's a great friend of mine, Kurt Hummel. We've worked together for years. He is the government guaranteed lending operations manager at South Central Bank. They are one of the best SBA lenders, and Kurt has been doing this for a long time, as long as I can remember. He's a good resource. So Kurt, how are you today?
Doing good, thank you, Dave.
Awesome. Let's see. I'm sorry. So it looks like chat's disabled, Janet. Maybe you should see if you can check on that for me.
Yeah, I'll check on that. If anybody has anything, go ahead and put it in the Q&A. It looks like that is up and running.
Okay. All right. So if you have any questions or comments for our presenter as we go along today, just put that in the Q&A. If the chat feature is not disabled for you, just put it in the Q&A button there at the bottom. Also, just a little reminder at the end of our session today, you'll see a survey. If you wouldn't mind taking that survey for us, it always helps us to get your input and your thoughts and ideas. So for our guest, Kurt Hummel, who is a great SBA officer. Kurt, I'm just going to turn it over to you and get your screen up here. And can you see that okay?
Yes, I can see it. I'm not sure if everybody else can see it, but I can see it.
Okay, great. All right, Kurt.
Okay, thank you. Good afternoon to everyone. At least it's afternoon here in Kentucky. I'm not sure when it's calling from, but it is definitely just turned after 12 o'clock. I'm going to go over some of the main points. Of course, I'm not going to cover everything because it's a pretty wide range of requirements that the SBA has. But I'm trying to get you to the key points to know if it may be something that might fit what you're trying to do, and talk about some of the different programs and some of the important little key issues with SBA lending. With SBA lending, there's three main programs that we use. The first is the 7A program. Then there is the Express program, which is actually a part of the 7A program, and the 504 program. They have different uses, and they're definitely different qualifications. I'm trying to go over some of those main things with you today. And I say, if you have questions along the way, you can ask and we can stop as you have the questions, as opposed to waiting till the end, maybe be more fresh in your mind. If you ask the questions, we can answer it as we're covering it. Can you go to the second slide, please, Dave? All right. The 7A program is the most widely used, and it's the most widely used and most general types of lending can be done through the 7A program. And it's like I say, it's a little bit different than the 504 program, which I'll try to cover now and later when I talk about the 504 program. But the 7A program is funded by the bank. There's no SBA money that's invested into it. What the SBA does on the 7A program is they offer a guarantee to the bank. They don't actually inject cash into it. And typically that guarantee, if it's $150,000 or less, it's an 85% guarantee that the bank is awarded by or offered by the SBA. And if it's over $150,000, then it's a 75% guarantee. Borrowers do have to pay an upfront fee, of which it can be part of the project and it can be financed, but somewhere between 2.77% of the guaranteed portion and up to 3.75% of the guaranteed portion. So when you get into a pretty large loan, that amount can be pretty substantial, but the benefits that you're awarded definitely, I think, offset that upfront fee that you have to pay. Currently, and I say they go on the fiscal year, October 1st to September 30th. The SBA does every year, based on their budget, they can change different things. Like during COVID time, there were definitely different things they were doing. But during this past fiscal year, which I guess, like I said, in September 30th, on any loans up to $350,000, there was no guarantee fee to borrowers. So that was a big benefit offered to you all, because that is a fairly substantial amount of money. The 7A loans, they can be a term loan or a revolving line of credit. Typically, on the revolving line of credit as part of the 7A program, it's under the cap line program. I honestly don't know a lot of lenders that do those. If they're typically going to do a line of credit, they usually use the Express program, which offers a line of credit. I just from talking to other SBA lenders and just from the banks I've worked at, not a lot of places actually use the cap line program. It does offer a higher guarantee, but most people that do lines of credit do that through the Express, which we'll talk about later. The maximum loan amount that you're allowed under the SBA program is $5 million. And that would go to anybody who's a 20% or greater owner in that business is required to guarantee it. And that would go toward their maximum benefit of $5 million. So if someone was a 20% owner in 3 different businesses, that $5 million would go to any business that they were a 20% owner or greater. So if you were with 2 people that you already were maxed out at $5 million and you were applying for another SBA loan that puts you over that mark, you're not eligible. You're only allowed a benefit of $5 million. For startup or business acquisitions, it always requires a 10% injection. There are some cases where the SBA doesn't require 10%, which would be more like a business expansion. Like you've been in business for over 2 years and you're just looking to add another location, or you need additional equipment for your business or something like that, then there's not an SBA, the SBA does not require an injection. Doesn't mean that the bank couldn't charge that, but to be eligible for SBA, like I say, it's 10%, could always be more, but it seems like to me like most SBA lenders usually stick with the requirement that the SBA has, but that doesn't mean that they could not ask for a larger injection. The terms, most SBA on the 7A program is mostly 10 years. Commercial real estate can be a 25-year term, or equipment that has a longer useful life than 10 years. It could be up to 15-year term, but most SBA lending is usually for 10 years. A lot of times on the real estate, not all banks, but a lot of banks would actually use the 504 program for the commercial real estate purchase. But you could do a 7A loan for 25 years. I guess it just depends on the different banks and their desire on how they want to structure it. But anyway, all payments on the 7A program must be fully amortized. They can't be a balloon payment. So there's no, 5-year term with like a 10-year amortization. The loan has to be fully amortized on SBA. Whenever you have a real estate loan or a business acquisition loan, you have to do an appraisal on the real estate, or you have to do a business valuation on the business. Whatever that value comes back at, the loan cannot exceed that dollar amount. So if the business is valued at $1 million, but they're trying to sell the business to somebody for like 1.3 million, not to say that you can't do the 1.3 million, but the SBA loan could not be greater than $1 million. There would have to be some seller financing or additional cash injected or something like that to bring the SBA loan amount down to the maximum allowed, which is, like I say, based on the value. You can have an interest-only period. The 7A program that does allow an interest-only period, but that would count towards your maximum term. So if you were acquiring a business and you had a 10-year term and you needed like a 6 or a 12-month period of interest only, of course, the bank has to approve that, but that would be allowed. But then your amortization term would be shorter. So if you did a 6-month interest-only period, then you'd have to amortize the loan out over 9.5 years. So that's kind of important. Like I say, you can't go over that maximum term. Anybody have any questions at this point about the 7A program before we move on? All right, next slide. Okay. The main uses for the 7A program, the types of lending that are done, really common one are business acquisitions. Those are very common. A partner buyout is a pretty common thing to do. Two things to know about business acquisitions and partner buyouts. You can't use the money to buy into a business. If you're going to get money from the or it's backed by the SBA, when you're doing this, you have to become the 100% owner. It could be like a partner. It could be like a partnership that's, maybe you and a partner are buying out a business, but you all or you yourself would have to become the full owner. You can't just buy 50% of the business. When you use the money, you're going to be the full owner of the business. You can use it for refinancing, but when banks use SBA money for refinancing, you can't just like use it to steal business away from another bank. When they use it to refinance, there has to be a benefit to you as the lender, which requires usually a 10% reduction in your loan amount to free up cash flow. That's a requirement. You can use the program for working capital. It can be done for a business expansion, business startup. You can, like I said, as we mentioned earlier, you can use SBA funds for commercial real estate purchase. It has to be owner occupied though. It's not for investment properties. There's nothing that's like passive investment involved with SBA. If you're going to use the money to purchase real estate, to renovate it, it's got to be owner occupied, which is at least 51%. Now you could buy a building that you weren't going to occupy the entire space. So you could buy the building, but any renovation money that you were using from the SBA to renovate your space can only be used for the space that you're owner occupying. You can't use the money to renovate the space that you're going to lease out to another business. Equipment purchase is another common use of the 7A program. And franchise, you can use money to purchase a franchise or to buy into a franchise. The only stipulation there is the SBA has what's called a franchise list. Franchises would, get approved prior, to their growth. They sent the SBA their franchise documents. They just don't want to see that the franchisor has a lot of control over you as a franchisee to come take your business away. So that's why they want you to get pre-approved ahead of time with the franchise. But that franchise has got to be on the list to be eligible. Most franchises that are looking to grow, I've never come across a case where the actual franchise was not on the franchise list. Next slide, please. Now the Express program is very similar to the 7A as it's part of it. The only thing is it's got the SBA offers less of a guarantee than they do on the 7A program. The uses are all the same uses you could do with the 7A, you can do with the Express. Again, it's funded by the bank. The SBA offers a guarantee to the bank of 50%. You still have the upfront fee of 2.77%, but just like with the 7A, there's no fee up to $350,000. Now, one of the things with the Express that's different than the 7A, other than the cap line, is like if a person was, buying a business, maybe they did a business acquisition loan, and then they needed working capital, and they needed a line of credit as opposed to just some permanent working capital. You can have a revolving line. You can do that through the Express program. So you could do maybe a business acquisition loan of $1 million, and then say you needed $200,000 for working capital and you want it to be a revolving line. You could do an Express loan for $200,000 for the revolving portion, and then do the regular 7A for the business acquisition part. The terms are the same as they are for the 7A, the maximum terms. Typically, it's 10 years. Commercial real estate could be 25 years. Equipment's based on the useful life. But one of the thing is on the line of credit, it's a maximum of a 10-year term, and only 5 of those 10 years can actually be a revolving. So they have to allow you whatever the time is that the loan actually revolves, which can't go longer than 5 years. It's the most it can be. But if you have like 3 years, say you only do 3 years revolving, the bank has to give you additional 3 years to term that debt out. But if it's 5 years, then they give you 5 years to term it out. If they only do it for a year, they have to give you at least a year. They used to not have that amount of time. And then so what would happen is people would do 7 years revolving and have a large amount. And then maybe only have a year or 2 years to repay it. So now it's whatever amount of time that you revolve it, you get that same amount of time to actually term it out. Maximum loan amount is $500,000 on the Express loans. And again, the same thing with an individual is only allowed up to the $500,000. So if you're a 20% owner on a couple businesses that have Express loans, you have to look at that gross amount. If you can't take a loan that puts you over $500,000. The advantage of the Express loan for individuals is maybe the bank likes it. It kind of depends on how much of a guarantee they feel they need in order to approve a loan. But the Express program definitely requires less documentation than a regular 7A loan. They just don't have the stricter requirements and as much documentation that you would need. Dave, are there any questions? I see there are, like the chat actually has 12 items listed. Are there any questions that people have?
I have one quick question. Tanisha would ask if you would maybe explain a little bit or define what amortization is.
So it's what amortization is like. Say you go get a car loan and you pay it back over 5 years. It's just you're paying whatever the SBA has the bank has whatever it takes to pay off $20,000 over 5 years. That's what your payment's going to be. When it gets to be a little different, amortization is like sometimes if you have a $20,000 loan, sometimes banks would do like a 5-year term with a 10-year amortization, which means after 5 years, that loan's not going to be paid off, and you're going to have you're going to have a large payment due at the very end of the loan. Does that answer the question?
Yeah, that's good.
You got a new question that's just come up too, Dave?
Yeah, I see it. So Cody says, currently in their very early stages of developing a business plan for a great event venue on a farm, which will also have my residential property on it. What is the best type of loan I should pursue for that?
I'm sorry, say that again. You cut out there. Say that they need.
The greatest expense will likely be the purchase of the land and not necessarily the building of everything, since I'm looking at 40 acres.
The SBA is a little weird about excess land as part of a deal. We have to get more detail on that. But if the land was being used for the business, that's one thing. But if it's just like you're going to buy a building to go on like an acre, but you're going to have all this extra 39 acres of land, that can be we have to, like on a 504 loan, which we'll talk about later, see to figure out how much they would allow on that, because they just don't let you buy 40 acres, use an acre, and then have all this excess land. Now, like I say, if the excess land was used for a business that actually used the land, that would be different. I'm not sure if that answers the question, but that's something you have to kind of go into and we have to work with the SBA on, because they get a little funny about just having all this excess land when you buy a building. They're going to look at the renovation cost of the building, if that would matter. I've seen people that do that and they parcel it out, the part that they're going to use for their business, and a separate parcel would be a separate loan away from the SBA loan. But say you need 2 acres, the cost of the 2 acres and the land to be built on there. Does that answer the question, or is that?
Cody, I think you should just best advice would be to just reach out to
lender.
Kurt or another lender and see what they would do.
Yeah.
Okay.
Any other questions?
Nope, that's it at the moment.
All right. Okay. Next slide. Now, the 504 loan program is very different than the 7A program. It's very restricted on the uses. It's strictly fixed asset lending. So commercial real estate purchase, or you could buy an existing building for your business, or you could build, ground up construction is also allowed under the 504 program, or you could buy a building, you could renovate it, and then also equipment financing. You can merge them together, but when you merge them, you might have some kind of blended rate between like the 25 years for the real estate, maybe the equipment's 15 years. So you might have a term somewhere in between there. That's when you work at the CDC to figure out based on dollar amounts what the term would be. But that's every deal is different on that. So we have to work with what's called a CDC. And we'll talk about that here later in this section, but that's so that the purpose and the terms can have to be worked out based on dollar amounts and what you're actually using the funds for. And this one, it's not just funded fully by the bank and offered a guarantee. This one, the SBA actually injects cash into the deal. So it's funded initially by the bank fully, and then later on the SBA will take the bank out of, it's like a first mortgage, second mortgage kind of thing. So 50% typically is the bank, somewhere in the 30 to 40% range is the SBA, and then another 10 to 20% is owner injection. So there would be a loan to the bank, there will be a second loan to the SBA when all said and done, and then like I said, you'd also have your cash injection. So it definitely is a little bit different than how the 7A program works. And like I say, that's the same thing as with the 7A program. It must be owner occupied, at least 51%. If you're doing ground up construction, it's 60%. But they're on ground up construction, they're going to want you long-term, your long-term goal is to get to 100% occupancy of that building. I'm not going to say that it's always going to get to that point. You might be paid off by that time. But if you ground up construction and you sign a couple 20-year leases with somebody, they're probably not going to accept that because that's not you having intent of taking the whole building. But those are just little details we'd work out with the CDC as it went along. And as I mentioned, it's the bank funds at least 50%. The bank could do more if they chose to, but typically it's usually the bank does 50% of, say you're buying a building that's $100,000 or $1 million, and then you're putting in maybe $500,000 of renovation money. So the total project is 1.5 million. The bank would have a first loan of 750,000. And then depending on some other, whether it's the business is a startup, if it's special purpose, it could add additional percentage, or if you have two special purpose properties, it could add a percentage, but you never put in more than 20% on a 504 loan, but usually it's always somewhere between 10 and 20% is the injection that's required. But what happens is the bank funds the 50%, they do a temporary loan for the SBA's part, and then in the future, the SBA will have a loan closing and they will pay the bank off, and then you'll have a payment to the bank and you'll have a payment to the SBA. Temporarily, when the banks fund the SBA's part, they'll do interest only on the SBA's portion until the SBA actually pays that loan off. And so, for a while, like say if it's, you're just buying a building, you move into it immediately, it's ready to be moved into, it might take 90 to 120 days, somewhere in that neighborhood, for the SBA to have their loan closing and pay the bank off. So for 3 or 4 months, you might have interest only payments. If it's construction, I mean, it could take a really long time before the whole project's complete, the business is moved into that property. So you'll be paid, you'd work out of the bank. You might even have, if it's new construction, paying the bank interest only for a time period, the SBA's part interest only. And then eventually, what it is, the SBA raises money through like it's called debenture sales. Every month they go out and get this money from investors, and then they know like the month before, okay, coming in, like say August, they know that they need to raise $2 billion. They go out and raise the $2 billion, and the SBA has all their loan closings in August to pay all the banks back this 30 to 40% that they're owed. So you don't, and another thing about that is you don't really know what the interest rate's going to be till the future. If anybody ever told you they know what the rate's going to be, they're not telling you the truth. The rates on the SBA on the 504 program are typically pretty competitive. Usually normally lower than the bank. I can't say they're always going to be that way. Like early COVID time on the 504s, they were down to like barely over 2%. Right now, I think they're more in the mid to upper fives as the rates have increased. But so it's just timing. You won't actually know what the SBA rate's going to be until the future. I know that's not a good way to do it, but that's just how it's done. The SBA doesn't have the money. They don't know what the cost to get that money from investors is going to be. So that rate gets set in the future. And like I say, on a 504 loan, we work with what's called a CD. The bank works with them, you would work with them, and we kind of all work together. What's called a CDC, a Certified Development Company. CDCs have like regions of the country or a state or whatever that they cover. And what they do is they act on behalf of the SBA. They would work with the SBA to get the loan approved. And then after the loan is closed, they service the loans for the SBA. So the SBA doesn't really get involved with it. They pay the CDCs to actually do that. The same thing, your maximum benefit with all SBA loans combined is $5 million. One of the attractive parts, I'll say it probably was more attractive a while back, but it's still attractive compared to the rates that you could get, is on commercial real estate. The SBA offers up to a 25-year fixed rate, depending on the term the bank charges. As long as the bank term or commitment to the deal is 10 years, then you can do 25 years. Hard to get on commercial real estate 25 years a rate fixed, but that's how they do. That's one of the benefits of that. They do, since they go get the money from investors, and this is investors putting the funding in, there is a prepayment penalty on 504 loans. It does decline every year. And the way I understand it from talking to a CDC, the way the penalty works is if you pay the loan off in year one, which I've never seen anybody ever do that, you would pay 100% of the interest that was due to the investors that year. Year two, 90% of the interest due to the investors that year. Year three, it goes down 10% every year. So we get toward the end, it's not going to be a lot, but there is a penalty on the SBA's part. Now, the bank may or may not, it depends on the bank and who you're working with. It may or may not be a penalty on the SBA, on the bank's portion of the loan. That's just, the banks are different. This would have to be whoever your lender is that you're working with that would set that. And as I mentioned earlier, you don't know what the rate's going to be on the SBA's portion until the future, maybe like 3 months out. Like I said, if anybody's telling you that they know what the rate's going to be, they're not telling you the truth, because that rate gets, when they have what's called their debenture sale, that's when the rate gets set for the following month. So, the 504 is definitely a little different than the 7A. You can't use it to buy a business. You can't use it to, get working capital or whatever. It's just fixed asset lending. And there's no reason. I mean, I've done deals where someone was buying a business and they bought the real estate. So we did the real estate under the 504 loan program because there are advantages to that. And then we did maybe the business acquisition under the 7A program. Then they also needed working capital. Then we did a third loan under the Express program to give like a line of credit for working capital. So there's nothing that says that you can't use multiple programs all at the same time. It just is a little more complicated to work it out. But so there's always that option available. Just like I say, just because you get one doesn't mean you can't use multiple SBA programs at the same time. Does anybody have any questions on the 504 loan program? How it works or what it can be used for?
Here's one question. Does the borrower have to be certified like a DBE or WBE or MWBE?
And actually, I'm sorry, one of the things I did forget, like a lot of times on the 504, but you do not have to be certified like that. One of the, you do have to be an operating business. And the way it would typically work, or the way I've seen it more often, somebody will buy real estate under like a limited liability company, just a real estate holding company. And then they have an operating business their operating business operates out of the real estate that they bought, which is okay. The operating business would be required to guarantee the debt, as well as the real estate holding company would also be required to guarantee it. And then any 20% owners of those businesses would also be required to guarantee the debt. So you could have, a loan to Company X LLC, and their operating company is Company Y LLC, and the individuals that own those businesses would also be required to guarantee it. So usually, I mean, I have seen businesses though that just buy real estate under their company. That typically they, for whatever reason, probably legal protection, they usually separate the real estate ownership from the business ownership. But that's a pretty common. So it could be done either way, but it's pretty common for those to be separated out. Anybody have any other questions about the 504 program? And
Nope.
I'm sorry, David. Again, it's like, this is not ever for passive investment. It's not to go out and buy a property to lease to somebody. You're buying a property to put your business in it. Or, Dave and I could be 50-50 partners, and maybe I have a business and Dave has a business, and his operating company is going to take half of it, and my operating company is going to take half of it. And then we form that, the company to buy the real estate, but then we have so that's something that there's different varieties like that that's also allowed. But basically the owners, operating companies have to be taking the space. And again, like with the 7A, you could buy the property and, your owner occupied at least 51%, you've got a portion that you're going to lease out. Again, you can use the money to buy the real estate, but you can't use any funds to renovate the section that's going to be leased out to somebody that's not part of you're not the owner of. You have to be like, we're leasing out 30% to a company that's just unrelated to us. We can't use money to renovate that space. That they would have to actually use, you have to use separate money to do that, or the company coming in would have to actually pay to have that space renovated. You can go on to the next. Now, if you really, when you go to apply for a loan or go talk to your lender, here's a list of documentation that if you bring it in, they'll be really impressed that you have all this together, and will definitely help speed up the process. It's whoever the 20% owners are. Again, anybody who's a 20% owner, you would need to have 3 years of your personal tax returns, the last 3 years. And if you file an extension, they would definitely also want the extension plus the 3 years. A personal financial statement from all the 20% owners. When the loan actually closes, the PFS cannot be older than 90 days. So you want to do the most recent PFS that you actually could. If it's an existing business, I'm going to go back to one other thing on the tax returns. Sometimes I think the 504 loans, they only require 2 years personal and business. But if you have 3 years, you're going to more than always cover yourself. So I would just err on the side of caution and always have 3 years. And again, an existing business, 3 years business tax returns. An existing business would need interim financials. So you have your 18, 19, or your 19, 20, 21 tax returns, and then you have interim financials through the end of June would be a good example, which would include a balance sheet, an income statement, and like an AR, an aging report. And if you really, when the bank supplies that documentation, all those dates have to match. So you couldn't have the balance sheet be through June 30th, the income statement be through May 30th, and the accounts receivable, accounts payable, aging report a different date. You want all of that information to match, and you need to sign and date it. The SBA is really picky about stuff being signed and dated. The same thing on tax returns. If on the front page, sign and date it somewhere there, that'll be required. So I don't know why they do that, because the bank goes out and has to verify that through tax transcripts, but that's just one of their requirements. And an affiliate business is, if Dave and I are 50% owners on a business, any business that Dave isn't a 20% owner on is considered an affiliate. Any other business I have, I'm a 20% owner on, considered an affiliate. We would need to have the same tax returns as what an existing business would have. The 3 years tax returns, the same interim financials. You'd have to bring all that to closing. That seems to be overkill, but they want to see that when you get the global cash flow, all of the businesses that we own, is our global cash flow still good? But that's just another requirement. Same thing, sign and date all those documents. A business plan, which I'm going to give a great plug here to SBDC. I've ever received for a SBA deal, a Small Business Development Center tax or business plan. Everything we need is always in that. Their business plan is really good, and everything we need for an SBA loan is actually covered in there. So definitely go to them. They do a great job. Their numbers are based on not just guessing; they're based on research. So It's like 3 years projections, at least the first year is month by month. Never hurts to have 3 years month by month, but it is eligible that the second and third year could be annualized. Sorry, I said it. See, I have a typo in here. I apologize for that. Never bad to have 5 years though. Plan should at least have cash flow projections in it, a business description, a marketing plan, competitive analysis, who your competitors are, what are they charging and doing, how do you separate yourself from them. Management and organization description, you know who the management is, what products and services you're selling, your operation plan, anything else in that business plan to tell the loan officer that you're dealing with. This is my business, this is what I'm doing. You're telling your story to that person so they can then go on to their committees or whatever, to their loan approvers, and they have a good story of, because they're going to have a lot of questions. You're selling yourself and your business on what you're doing. So having all that in your business plan is going to be great. If you're acquiring a business or you're purchasing real estate, the purchase contract will be needed. That is, giving just to have, they know what we're looking to buy it for. Then when they go to do the appraisal or the valuation on the business or the appraisal on the equipment, they know, are we in line here? If a business leases space, you need a copy of the lease. If you have your articles of incorporation or organization, that would be great. An operating agreement, it's not always required, but I would definitely recommend that. If you're a veteran, you'll know what this form is. It's a DD 214. Sometimes the SBA actually has a benefit to a veteran. So to prove that you are a veteran, the DD 214 is needed. The most recent bank statements, it helps the banker verify your liquidity for your deal, or if there's a cash injection required or for working capital, they're going to be able to use that to verify that information. If you're doing if the loan is a franchise, the franchise agreement would be good to go ahead and give the person if you have it. And there will be other SBA documents that'll be done, but there's nothing you can really fill out ahead of time. I've always hated to put a person through all the SBA documentation. If the loan is not going to be approved, or a lot of times the loan amount changes so that the documents change, I like kind of wait till later on in the process to have a lot of the SBA documents. And then there's other specific SBA things that will be needed. But that's, you'll work with your lender at that point and they'll let you know what you need. Any questions? But again, if you have all this documentation, you have your business plan, you bring it to your lender, they're going to be really impressed to know that you're really serious about what you're doing. And this is a really good start of the documentation that you'll need. Any questions about the documentation?
Nope, no open questions right now.
Somebody say goodbye. You go, man.
Here's some quick, just like little tidbits and facts about SBA lending. SBA never requires collateral on a loan, but they only require it if you have it. And personal real estate may be required. Now, when I get to the personal real estate, this is one of those, what the bank requires and then what the SBA requires. The SBA, if a loan is considered not to be fully secured, like you're buying a business and it's a lot of goodwill, there's just not any tangible assets there that you're buying that's enough to secure the loan, personal real estate may be required, but the SBA only requires personal real estate if there's at least 25% equity in that property. And the way they can determine that, they don't have to do an appraisal to determine that. They can't use what you put on your PFS. They could use like a Zillow value, and if Zillow says it's worth $1 million, and your mortgage statement shows that the property is worth $500,000, there's more than 25% equity, you're going to have to pledge that personal real estate to the SBA deal. There's no, SBA will not allow it without, they won't approve the loan without that being done. Now, if you owe, it's $1 million property, you owe 900,000, the SBA is not going to require that. That doesn't mean that the bank may not ask for it. More often than not, if there's a big shortage, they're going to probably ask for everything. And when you go to have something like that released, you could always swap out collateral. Like say you sold your house and you're just putting the money into another house, you could change collateral, the bank could swap out collateral. Or if you want to sell a property, they could sell it and all the proceeds have to go to pay down the loan. But they would never let you, there's not many cases I've ever heard of where the SBA would let you release it unless it got to a point where the loan was paid down and there was enough collateral to make the loan fully secured with releasing maybe your home, then that would possibly be allowed. There may be a life insurance requirement. There's always going to be on a 504 some weird form that they use. Only way I never know is when you get the approval back after getting, your approval from the SBA, they're going to say X amount of dollars is required on the owner for life insurance. That's always on a 504 loan. On a 7A loan, if it's a single member LLC, or it could be a partnership where maybe one person's kind of a silent partner, they're not there to run the day-to-day, it's reliant on one person. Or if that one, something happened to that one person, the business would shut down or would be struggling, then they could require life insurance for the unsecured portion of the loan. I've heard a lot of people always asking this is what's the credit score required by the SBA? Well, the SBA doesn't really have in their regulations what a credit score a number that's required. You have to have a 660 or 770 or 720. They don't have that. But where that's really dictated is, since the bank has to approve it, I guess it goes back to what your bank and what your bank's policies are and how they review and look at credit. So I can't tell you what a number is. That's going to be whatever loan officer or whatever bank you work with, their own guidelines will probably dictate that. The guarantee fee, as we mentioned earlier, the guarantee fee that the SBA requires you to pay, that can be financed as part of the project. If you've ever filed bankruptcy that caused a loss to the government, or you currently have some delinquent federal debt, it's probably going to make you ineligible for SBA lending. A felony conviction, depending on the type of felony conviction, if it's financial related, it's likely going to make you ineligible, or recent arrest could make you ineligible until it's cleared up. That's definitely done on a case-by-case basis, depending on what happened. And those things will have to oftentimes be cleared by the SBA, which will take some time. So it's not that your loan can't be done, but it's definitely going to slow your loan down. The process time is going to be a lot longer. There's a thing called that the SBA requires, is called credit elsewhere. And it's for an SBA loan or to be eligible for SBA lending, there has to be something that makes that loan where you need the government guarantee to have a bank approve it. And it's usually like one issue, like maybe you're buying a business, the business has good cash flow, the person has good liquidity, but only thing is maybe lacking is collateral. So based on the lack of collateral, the bank would ask for SBA guarantee just in case something happens. But if you have like no liquidity, you don't have experience, you don't have collateral, more than likely the bank's not even going to look at it or approve it. So it's usually on this credit elsewhere thing, it's just when there's one little issue, or there's one issue that makes it where the bank is not comfortable. Maybe even it's the type of industry a bank doesn't like to lend to. Certain banks have certain sweet spots on things they like to do or kind of deals they like. Maybe large banks don't like to look at smaller loans. Maybe some smaller banks, when the loan gets too large, maybe they're a little hesitant. There's no way to tell, but in order, when a bank does it, there has to be some issue that makes the need for the government guarantee there. If it's a good loan, everything's good, you really don't need SBA, and the SBA would not approve it because they're not needed. Because the bank has to say, we need your guarantee because of this reason. The SBA doesn't, people say, oh, what's the SBA rate? The SBA doesn't set rates. What they do is they set maximum rates that banks can charge. So if they're going to guarantee it, they're going to want to make sure that it's a rate that, that's reasonable for a person. They're going to guarantee something and not let a person charge this huge interest, let a bank charge this huge interest rate. They're going to set the maximum rates. On most loans that are larger, prime plus 2.75 is the maximum rate that can be charged. That just recently, I think it used to be prime plus 2.5, but it's 2.75 now. On a business acquisition or partner buyout, like we talked about earlier, you have to become the full owner. Can't use the money to buy into a business. You have to use the money to become the owner of the business. And they do allow like a short time for the existing owner to kind of help you transition, but they pretty much want the owner out of the business no longer than 12 months, but shorter would be definitely preferred. There are like the benefits to SBA lending. If you have a loan that has some like a collateral shortfall and you can probably get a loan somewhere else, but the rate's gonna be much higher. So the SBA, by doing this a lot, has a more competitive rate. They limit the banks on the fees they can charge. One of the things banks like is like have a floor rate where the loan, if it's variable, it can't go below a certain rate. Well, the SBA doesn't let a bank just put in a floor rate without having an equal ceiling rate. So if it's, like right now, what is prime? You're ready to go up again, but it's I think 4.5. So if the bank comes in and has a floor rate of 3.5, they can't have a ceiling rate more than if it's 1% below prime. They can't have a ceiling rate that's any more than 1% above prime. So typically, you're not going to have a floor rate because the banks don't want to limit the upward movement of it either. So on most SBA loans, you don't have a floor and ceiling rate. Not that you couldn't, but it just doesn't happen that often, I don't believe. And like I say, I don't know what bank you work with, but this is kind of an important part. Banks, like I was talking about earlier, banks have different appetites for lending. I don't know, like certain industries, certain amounts. Like I've always heard some people say some larger banks don't like to deal with smaller SBA loans. And I know I've maybe been places that some smaller banks get to be a larger loan amount, they get a little nervous on those. So just because you go to your bank and they say, no, it's eligible, we just don't want to do it. If it's SBA eligible, there's probably a lender out there somewhere that would do it. Like I said, there's lenders that do SBA for very different reasons. There's some that try to grow like their C&I lending. There's some that are just trying to use it for their current customers if they ever need it, to be able to just service their current people. There may be reasons like they just use it, they want to like relationships. They just want to build relationships. But there's other SBA lenders that actually sell off their loans. And all they're after is the fee they get when they sell it off, sell off the guaranteed portion of the people. They come in, they get that, they sell it. They're just after bulk, massive amounts of loans, and they do nationally. So different lenders, different areas do it very different. I can't tell you what the bank is that you bank with on how they do it, but I would say if just because one bank says no, doesn't mean it's not an SBA lender out there for you. Any questions about that?
Nope, not at the moment.
And here's my phone number and my email address. Like I say, if you think of something that pops into your mind after we've gone through this, or you just have more detailed questions, just like, maybe, is this even an eligible deal? If you just have any questions for me, there's my phone number, there's my email address, email me or call me, and I can try to answer any questions. It doesn't matter if you come to us, I'm not interested in that part. I just want to know if somebody wants an SBA loan and they just have questions, because I know there's a lot of bad information that's given out there. People misunderstand things, or people misunderstand it and they spread the word about SBA lending. It's really not true, or there's maybe the structure or what's the best way to go about it. Feel free to give me a call. I can try to answer any of those questions that you have. Be more than happy to help you in any way that I can. So if there are any other questions about SBA lending?
Not at I don't see anything, but Kurt, you mentioned early on about like the 10% injection. I thought most banks, on a 7A would require like a 20%. So they will go to 10% at some point, sometime.
And that goes back to the what's required by SBA and what a bank requires. The SBA only requires that 10% is put in. That's one of the advantages of the SBA program, is maybe a less injection, and a bank might be more apt to do that, having that guarantee. They might require a less injection. If you weren't doing SBA, they may require that. The places I've been, we pretty much, when we do an SBA loan, we stuck to the 10%. But like I say, that doesn't mean that they couldn't ask for more. You have to remember there's a minimum requirements that the SBA asks for, and then the bank always has a discretion to like do more. Just like with the real estate, private real estate, where if it's less than 20% equity in the real estate, the SBA doesn't require it, but oftentimes a bank may require it. So they can always require more, they just can't require less.
Gotcha. That's good information. Let's see. Do you have a list of, or where would someone find a list of local banks in Louisville, Kentucky, that help with the Express program in 7A loans?
Honestly, I I don't know where they actually have a listing like that. It's hard for me to imagine that any bank wouldn't have at least some ability to do that, or it may not do a lot of it, but it's hard for me to imagine that a bank doesn't do some form of it. I guess there may be some really small banks that don't have the knowledge or the expertise to actually be able to do an SBA loan, because there are a lot of regulations and a lot of time involved. Maybe some people just don't want to fool with it. But if your bank, if your bank's not one of them that does it, you just have to talk to them and say, do you do SBA lending? Just ask them. But I don't honestly know where there's a list, but I guess there probably are some small places that don't, but you just have to find a different lender at that point. I'm sorry, I don't know where there's a list like that.
Yeah. So John says there's the Business First has a list of banks doing SBA loans.
That I believe is just that usually shows, I think, who actually did SBA loans for the year.
Yeah.
And you can go to the SBA like through Kentucky somewhere, and it does show like how many loans, the different banks, how many 7(a) loans the banks have done. And then if you look at remember like in the 504 loans, about the CDCs, those actually get credited to the CDCs. You know that this CDC did 5, this one did 7, this one did 9. They do have that listing too, but that doesn't, when you look at the 504s, it only goes by showing the CDCs that did them. It doesn't show the banks that did 504 loans, because really the bank's loan really at that point it's just their own loan that they have a first mortgage on. And then the CDC actually services and carries, and the SBA carries that second loan that I talked about. So that's where it gets recorded on the 504 loan. So you really didn't know what banks were involved in the 504 loans.
Yeah, if you go to the SBA site, sba.gov, and then use their little search function and search for their resource guide, they have a list of lenders in Kentucky.
Oh, they do.
Yeah, yeah. Rachel wants to know if she wants to extend her business to another state. Can she use an SBA lender from Kentucky?
Sure. Yeah, there's nothing that stops her doing it at another state like that.
Mm-hmm. Good.
Kentucky, we've like here in Louisville done loans in Southern Indiana. I don't know if you have, I don't know, were you just like a satellite office, or are you talking about like just opening your headquarters up there?
Yeah, I don't know. Maybe Rachel could put something in chat there and clarify.
I know there's national lenders that do loans all over the country, so I
True.
Stopped going.
Yeah, that's
I
right.
would honestly, if I was going to be headquartered or located in another location, I would personally probably find a lender in that area. Just make it ease of, having a relationship with the bank there, as opposed to, living in Michigan and trying to bank out of Kentucky or wherever you are. I think I would probably recommend that you go to that state and find somebody.
Yeah. Okay. That's like. Yeah. Rachel says, thanks. That makes sense. Okay. I think that's all the questions we have at the moment, and we're right at the top of the hour. So you see Kurt's contact info there. I recommend that you reach out to Kurt. He can certainly answer any questions you have. He's been a great resource to me and the SBDC here. So Kurt, thank you for all you do for us and you do for the community. Thanks for joining us.
It's not just like in my past, prior to coming to the bank, I worked and for the City Department of Economic Development. So I've worked with a lot of other government-backed programs. I know there's other things out there. Because not everybody would be quite ready or eligible for SBA lending. That doesn't mean there's not other loan people out there that could help you. And I'm sure Dave's probably worked and know a lot of those different people, but there are, just because you're not eligible for SBA doesn't mean there are not other programs out there as well. Like Community Ventures has like an SBA, like a microloan program that only goes up to like 50,000. I'm not sure what all their requirements are on theirs, but so there's smaller loans there. And like say, Department of Economic Development with the City of Louisville, I know has some programs, but that's only for Jefferson County. And then there's other like lenders around the city too. So, but I'm sure Dave and SBDC are pretty familiar with all those.
Yeah. Feel free to reach out to us. We're happy to help. Kurt, it's always great to talk to you.
Thank you.
Hope you'll come back and share again. Been great.
I will.
Thanks, everybody. Thanks for joining us for another Toolkit Tuesday, and we'll see you here shortly in another week. I think we got some other stuff coming up, so please watch your calendar and watch our emails, and we'll see you next time. And don't forget, we have a survey link here at the end. Go ahead and, if you wouldn't mind, give us your response on that survey. So thanks, everybody, and we'll see you next time.